What up, folks? We ready to get back to it? Welcome back to the Gauntlet, which consists of the US dollar index, the 10-year yield for the US, the 10-year yield for the Japanese yen, the VIX, and the fear and greed index for the stock market, and the fear and greed index for crypto. The financial system is what we're dealing with. This is like a snapshot. Obviously, the market doesn't open for another couple hours, so that means nothing's moving. Crypto's moving. Crypto's 24/7. So we do this snapshot before market open to see, and we deal with the daily chart, getting folks on the same sheet of music, from the newbie all the way up to the experienced trader. People will say, well, I don't follow. I don't understand. It doesn't look like something I'm going to be able to understand. It seems so technical, right? Because of what else is out there in the world. It creates confusion, and the market makers want you confused. So my goal is to tell you things that nobody told me when I first started. It was told to me along my journey that when the dollar goes down, assets go up, and when the dollar goes up, assets go down. It's not 100% true. In the long run, it's definitely true. And we know that the dollar's losing value. But it's really, that's why everything seems to be getting more expensive, is because our dollar is losing value. And we're starting with the dollar because I want to show you how it fluctuates. Now, if you look at the structure, right, it took roughly 2 weeks to get down from the top, and then it went back up. What most people don't see is that from point A to point B, A being the top and B being the bottom, and then it went back up 50%. How do I know it's 50%? Because it went halfway back up. That's all it is. People will say, oh, well, put the Fibonacci retracement tool on it. You don't have to put a Fibonacci retracement tool on it to know that that went back 50%. Now, before it went back 50%, it went from the top to the bottom. And then when it was at the bottom, you're like, oh, well, where could it go back to? Well, it can go back to 50%. You just have to expect that, right? Because that's how the market makers work. They will always bring you back to the middle of price, the middle of structure, all kinds of middles. And then they put you in the middle, and then they dare you through your impatience to make a decision while it's in the middle. Because when it's in the middle, it can go 50% to the upside and it can go 50% to the downside. And no matter which position you choose, both of them are wrong because you're making a decision in the middle. Now we're saying that with the structure itself. Okay, well, how do you implement the price? Why are we implementing price with the structure? We should be implementing structure with the price. And this is why people are confused, because they do the rocket science first and they forget that you were supposed to learn the numbers first. That's why I'm constantly regurgitating the number and then the concept that you have to do the numbers first. 100. You see it on the price right there, 100. That's the value, right? I don't know where the number 100 comes from. I don't really know, and I don't really care. All I know is you can start understanding percentage. Because if I put the basic scale of 100 on there, you know the premium is 110 and then 100, and then the discount is 90. See? So if it drops from 110 to 100, it dropped by 10%. And if it drops from 10% to 90%, then it also dropped by 10%. In total, it dropped 20%. And people will say, oh, well, the dollar, it loses 7% of value every year. Well, now it's 10% of value. And if that holds true, then that means by the end of this next year, the dollar should be down towards 90 and not at 100. I have to show you the numbers. The numbers will have to make sense to you, and we do what's called the gauntlet every week so that you can look at these gauntlets and be like, okay, I see where we're going with this, right? Getting everybody on the same sheet of music. So, oh, the dollar goes up and assets go down. And oh, when the dollar goes down, assets go up in the long run, right? Why does the dollar go up? We'll use the toilet paper concept. If you have one roll of toilet paper for your city, you're going to have a high demand for toilet paper. It's funny that I use toilet paper because we're talking about dollars. It's shit paper. So if you have one roll, then there's a high demand. Until more rolls come in, more dollars, right? They have to supply more dollars. When they supply more dollars, then the value goes down. See, when people are spending the money, they need more money to replace the money that they spent, and they haven't received it yet. That means you're spending the money, which means the dollar goes up. You see what I'm saying? Not just for the U.S., for the whole world. It's the world currency. So whenever money's being spent in the world, and we just went through the holidays and all that, right? It's starting to reflect that everybody spent all their money and the value of the dollar day by day by day. These are daily candles. And you see it took 2 weeks for it to come down because there was a printing of money. What do we say? Oh, 40 billion to the banks and all that. Yeah, you see all those days that it went down? That was that 40 billion. A supply of dollars into the system, which makes the dollar go down. And then when the dollars are spent, then the value of it goes up, right? And I don't want to be too long on this, but I really wanted to give some real emphasis to what we do when it comes to this gauntlet is explaining these concepts about the dollar, because most people don't know that there's a dollar index. They don't know that it has a price of value of 100. Oh, a dollar's worth a dollar. No, it's not. This is the value of the dollar, right? So I think I said enough about that. Let's move on to the 10-year yield. Now, the dollar, the DXY, the Dixie as we call it, the dollar index, is the value of the dollar itself. Now, the 10-year yield is the cost to borrow that dollar, the cost to borrow it. It is a percentage, and it's at 4%. It's above 4%. We're supposed to be at 2%. If the Fed was doing what it said it was going to do, then it would be bringing the percent to borrow the dollar down to 2%. That's the goal. That's supposedly the goal. But they're leaving the interest rates higher for longer, which only benefits rich people. They don't care about the interest rate. They have enough money to buy whether the interest rate's high or the interest rate's low. But most people who have money, who understand money, knows that eventually those rates are going to come down to 2%. And they're going to wait to do any kind of purchases until that percentage gets from 4% down to 2%. Now, again, these are daily candles. You were down there at the bottom for a little while, and then it came up and then started going sideways. That's a problem, because when you go up and sideways like that, chances are you're going to go up again. We want the rates to come down from 4%, but it looks like the rates are going to go up from 4%. Poor people can't borrow as it is, let alone borrow at a higher interest rate. And when people want to sell their houses, they can't sell their houses at a higher interest rate. Nobody wants to buy the house at a higher interest rate. Everybody's waiting for the rates to come down. We're waiting for Jerome Powell to lower the rates. And he hasn't done it yet. So this is what we're waiting on. And again, we're doing what's called the gauntlet. So I run across these things, right? We're not necessarily trading them, They're aspects of the market that you want to pay attention to so that you can make quality decisions. And we're looking at it week by week, so you can see the variation from week to week on where it's at. Now, supposedly, we're not going to cut the interest rates. We're going to pause on January 28th. That's when the meeting's going to happen, and Jerome Powell's going to come out and say whether we're going to cut again, because we cut in September, we skipped October, we cut in November, and we cut in December. 0.75, 0.25, 0.25, and 0.25, 0.75. Now, January, we're going to make a decision. February, we're going to make a decision. Are we going to cut or are we going to pause? We're supposed to be cutting because it's quantitative easing. Easing means we're cutting rates and we're going to print money. You see why they're not really printing all the money? Because you don't want to do it at a high interest rate. You want to cut the rates and get them down so that when you print the money, you can start making your purchases at a low interest rate. Even the government is waiting for the interest rates to come down because it's better to do your purchasing at a lower interest rate. All right, so we go to the 10-year for the Japanese yen. You see all the way up, but it's at 2%. See, that's where the U.S. is supposed to be. But Japan came up from 0 up to 2%. And now the U.S. dollar is 10-year is supposed to come down from 4% down to 2%. And meet Japan as it comes up to 2%. The U.S. should be coming down to 2%. We're supposed to meet right there. We are late. I'm just going to say, I don't know, but I'm just saying. Any country should be around 2% because that's the goal for everyone, is to be around 2%. That's where everybody's marker of success is around 2%. So this year, we're trying to figure out, once we get the new Fed chair in place, is he going to get these rates down to 2%, which is a benefit to all of us. We go to the volatility index. We see it's down towards 15, 35, 25, 15%, right? 15. That's the discounted area, right? And we see once the numbers came out on Friday, it dropped. If you look at the length of all these candles, the biggest candle is that big yellow one up there. Now, none of these candles can hold a candle to that candle, right? So it just goes to show the volatility index. It can get really volatile. The candle can be extremely long. Now we're hovering down here at the bottom. When the VIX is down at the bottom, then the market wants to go up towards the top. And when the VIX goes up towards the top, the market will fall and come down towards the bottom. So I don't have to go too far on this today. We don't want to make this too long, right? We got the fear and greed index is hovering in the middle. Buy low, sell high, stay out the middle. Same concept. You want to buy when it's extreme greed or extreme fear. Low, when the marker is low towards extreme fear. Think about it. When the marker is low at extreme fear, most people are running away from the market. They're not trying to make no purchases. They think it's going to zero. Whatever it is that they're involved with, it could be crypto, it could be gold. If the market, whatever it is that they're paying attention to is heading in a downward direction, their mind is not telling them, oh, this is an opportunity to buy. No, they're in extreme fear. And you have to do the opposite. Fear and greed index for the stock market and fear and greed index for the crypto market. Same thing. And they kind of do the same thing, which is good for us on these gauntlets to keep getting everybody on the same sheet of music week by week by week, so you can check in and be like, oh, yeah, we talked about this, right? All we're doing is getting people on the same sheet of music. So shout out to an awesome trading week in advance, an investing week. You want to be on the right sheet of music so you can make great decisions. You know, if you happen to get a trading account and you can apply these techniques to what you're doing and getting yourself in the know, so that you can put your money where your mouth is. And you know, we do it for the people and not the profits. It's the consistency and persistency that wins in the market. To beat the market, you must become the market. And the market moves with integrity through its price. If you lack the integrity of the price, then you're going to get wrecked. You'll be in loss review, talking about psychology. And we don't want that, right? Hey.